Hi, this is Gene Paulson, Executive Vice President of Sales for Gravity Investments. I'm here to demonstrate the Gravity's robust algorithm-based technology that was originated in the year 2000 and has been regularly added to and improved since that time. This technology is the backbone of Gravity's digital advice platform, or ROBO. This ROBO service includes full online account opening and profiling, and then adds additional benefits for the advisor's use. It allows the advisor to build assets under management, to build portfolios that are going to meet their objectives. It allows them to show side-by-side 3D comparisons of the old portfolio versus their recommended portfolio, and generate that as a 3D PDF interactive sales proposal. I will also show you how we use our custom policy tree to build guidelines and rules for building these portfolios, how we can put these portfolios on automation, and how this entire program will work to help build assets. I'm going to sign in here real quickly, and this is the basic starting point or starting block of our software. Within this system, I have a number of different tabs. For the sake of time today, I'm going to try to go through these relatively quickly. The Investor tab is strictly a tab where I'm going to list prospects and/or clients, contact information, and basic profiling information. My Portfolio tab is where I'm going to list and house a library of all of those portfolios that I have analyzed in the system. Where we really start using the system to gather assets, which is the first step here, is I'm going to take a client's portfolio and I'm going to analyze it for diversification, which has been shown that proper diversification adds very well to alpha or return of a portfolio. It also helps protect that portfolio from a risk perspective. My options here is I can enter a portfolio by symbol and then note the allocations for each. I can upload an Excel file, or for the sake of simplicity and time here, I'm just going to take a portfolio that I've already put in the system here. You put the amount of the portfolio into the system. I'm going to just call this example 10. I download this portfolio into the system, showing the positions, the allocation, the number of shares, and the value. And then I'm going to calculate this. Using a needs-based selling approach, what this attempts to do is show the client their portfolio in 3D graphics. Most of our clients do not understand all the nuances and definitions within the word diversification, although most of them know that's a pretty good thing to have in a portfolio. What we're actually doing here is we're showing them their portfolio in 3D, showing the relationship between all of the different assets in that portfolio. So this portfolio within this sphere represents the investable or diversifiable universe. This shows us that we've only got a very thin slice of what we could have from a diversification point of view. We then measure that diversification and we break it out as market risk, which is systematic risk or the risk-return trade-off. Diversifiable or non-compensated risk is risk that's taken in a portfolio that really doesn't give us any benefit of added return, and then an overall portfolio diversification score. We then come down and show the past performance of this portfolio. I can pick whatever kind of time frame the client wants to see or you want to show, and this is what their portfolio has done over this time frame. I can also add a benchmark to this portfolio and to check whether or not they're actually receiving what they're paying for. and are they meeting the benchmarks that they've established? As we can see in this particular example, here's the portfolio, and here's our S&P 500 benchmark. As we can see here, this portfolio is underperforming the S&P 500, and this client would have been better off strictly buying an index and instead of paying a management fee. What we're showing the client here is the need, why they need improvement. You're trying to show them that you can provide them a better result without having to say you have the best stock pickers in the world or better financial minds than everybody on the street. You're actually showing them graphically that they're deficient. Coming back up here to the sphere again, I can also show you within this sample, if I were to hide what I call efficient assets, I'm now showing inefficient assets, which are putting a drag on the portfolio's performance. So one of the concepts here is obviously to remove inefficient assets from a portfolio, excuse me. I then show the typical pie chart risk-return bubbles that are familiar to a lot of clients. I show the various dimensions within the portfolio. In this particular case, I'm at 2 items out of the 9 in this portfolio control over 50% of the portfolio, which means it's poorly diversified. I then come down and show the positions in the portfolio, performance metrics, max drawdowns, standard deviations, all of which can be used by the portfolio manager, drift reports on each of the items, charts, and then a correlation matrix chart. This particular section is used to show the client the need of getting a better result and having a better portfolio. I'm going to go back in a few moments and show you how we build portfolios, but I'm going to carry this to the compare function, which is a sales presentation. This presentation can be printed or emailed in PDF form, in 3D, and is interactive for the client. What I'm going to do again is I'm going to pull down a portfolio, and I'll pull down that one I just had up here. I should be able to spell sample more correctly than that. I'll also come down here then and I'm going to pull in a portfolio that we're going to assume that you've created. These portfolios are created using our policy trees and on the more deep analytical side, and I won't go into great detail there, but I'll just show you how it's done. But right now, all I'm attempting to do is show an existing portfolio versus a proposed portfolio. Excuse me. The system basically is using all of last night's closing prices to come up with these numbers and these graphics. Here's the existing portfolio, and here's the proposed portfolio. This proposed portfolio is not refined yet, but it's just one that I started to use as an example. What I can see here, looking at the diversification meters, particularly on the non-compensated risk basis, I've moved the needle quite nicely into the safe or super abundant area. I still need to do some more work on it, but that's the great starting point. I can show whatever observation period that I want again within this portfolio. And again, it's crunching numbers live here. Here's its sample portfolio we started with, and here's the proposed portfolio. As you can see, we increased performance. I can also apply benchmarks to this item, and I give the various other metrics within the report. But in this particular case, I can show the sample, I can show the recommended, and ideal, which is never achievable, is this line right here. Once I've put this all together, obviously I can show this at the desk right directly to the client, or I can generate a 3D report which shows all of this side by side and is fully interactive. So now what I've done is I've created a need for a new approach for this client to improve their situation. I've shown a proposal that started to enhance their situation. Again, I would refine this more completely going forward. And I print it out as a report. How did I get here? I'm going back to the modeling tab, and I've got what's called a policy tree. A policy tree is where I set all of the guidelines that I want to control a portfolio. This, in fact, is something that will be built. The policy trees are typically built internally by the portfolio managers and set up the guidelines and rule sets for various portfolios, be they conservative, aggressive, balanced, or any place in between. We're allowed with this thing, we can do automatic walk-forward multi-period back testing on various samples. I can set automatic rebalancing and reoptimization numbers. As part of the automation, once these tabs are set, not only does it help build the portfolios, but it then can automate trade instructions and actually transmit those trade instructions to the custodian to maintain the portfolio. And I won't go very deep into all of the different capital market assumptions that go into this, but let me just say that it's probably the most robust digital advice platform in the world today that allows the exact portfolio manager capital market assumptions to be put into the process. From a compliance point of view, this also allows the home office to lock down how portfolios will be handled. Once I build a portfolio, it's named and it's in the system. I'm going to jump back here very quickly, and I'm going to import a portfolio again, just to load something in the system here. I put in a dollar amount to load the portfolio. I import it into the system. Now what I do is I clear the existing weights. So a client comes in, here's a prospect's portfolio, but I've eliminated the weights. Based on the home office portfolio manager, or depending on the level of the reps, this can be pushed out to the field. We have various permission levels, from administrator to portfolio manager to advisors. I then can come down here and import candidate sets. So let's just pick Strategic Alpha as an example. And I'll import that as a potential candidate for this portfolio. If you have already built models within your system, those models would be here, and we could strictly pull down a model to go with the client's existing portfolio. It also gives me the ability to go in here as an example and say, okay, my client is a director with Citicorp. He cannot sell his position, and he's 15% of his portfolio is there. We can mark that as a minimum and put a constraint on that portion of the portfolio so that we'll always maintain at least 15%. Once I have any of those constraints put in place, I'm going to go back and I'm going to pick a policy that's based on that rule set, and I'm going to apply that policy. Once I've applied that policy, I ask the system, and I'm going to name it here, call it optimize sample, and I'm going to optimize it. What I'm doing here is I'm taking the client's existing portfolio, I've taken the limited candidate set that I just gave it, and I've asked it to build me a better portfolio. So the system just created this portfolio. While not yet perfect, I have definitely improved my scores. I have added more diversification. I still have a few inefficient assets that I have to knock out of this, which I can go right back down and take out when I edit this portfolio. I show its performance over the period of time. I can apply benchmarks, and as you can see in this particular case, by adding additional classes of investments, I greatly improved my sources of diversification. Again, with this one being perfection, I've gotten a lot closer to it. So what I've tried to briefly do in this little tidbit here is I showed you how to analyze a client's portfolio and show its pitfalls. I have shown you how to compare side by side those portfolios and then create a 3D PDF report of showing that. I can create a report at any point on an individual portfolio or on the side by side, or I can do a very detailed report that shows all of the data that appears on this screen. A couple other ways that this software is used and helps you go after all sorts of different business is that, as an example, we've had mutual funds doing this, to use an overlay to improve the diversification and performance of a given mutual fund. We don't claim to have all of the investment knowledge in the world, but we believe that our technology, coupled with the wisdom of the portfolio managers building these portfolios, helps them better measure diversification and helps add to their alpha. A few examples of this is that in the Journal of Indices did an article, a large article called in the Legends of Indexing, where Gravity took the S&P 500 over a 16-year period and applied our diversification weighting metrics to that same S&P 500 and did nothing other than to change the weightings of the items from cap weighting. We were able to generate returns of over 427 basis points a year annually over the life of that test. We have recently applied this same technology to the TSX 60, and although we're still in preliminary work on it and doing additional modifications, we're looking at improvements of 600 basis points on the TSX index over the time frames measured. So basically what we're looking at here is a tool that will allow the client to actually, through an embedded website, go online and open an account, enter their profiling information, have that profiling information score that client, and then direct them towards a portfolio or a model that your portfolio managers have built and made available within the system. This also allows protection from a compliance point of view in that none of the advisors can really get out of the guide rails created by the portfolio manager by using your models or by using the candidates for a proposal that the home office or portfolio managers have designated as appropriate candidate sets for a portfolio. This lets you lock down what can be done in the field. I've gone through this very quickly to make this simple, to show how we can help build assets by showing deficiencies in the client portfolio, how we can build new portfolios and make them better achieve what's shown in an investment policy. It shows how we can do side-by-side proposals as sales. We can automate this entire process so that once an account is established and designated as automate, it will automatically optimize and reallocate those portfolios based on the rule set put in within those policy trees and generate trade instructions directly through the custodian and your trading platform. This is all brought through the system to give you a seamless online digital advice platform with the deepest algorithm-based technology available on the market today. I hope that's helpful. It was meant to be a very brief introduction, but hopefully that it has made that point. Thank you.